Welcome to this explainer. Today, we're mapping out the hidden terrain of the 24/5 Forex market. It's funny how often people forget this, but we're going to see exactly why when you trade is just as absolutely crucial as what you trade. For a lot of traders, mastering market timing is kind of that missing piece of the puzzle. So let's piece this whole thing together right now. Right off the bat, let's challenge a massive misconception. Just because the market is technically open 24 hours a day, 5 days a week, doesn't mean you should be actively trading it all the time. That 24-hour cycle, it's really an illusion of continuous opportunity. In reality, the market breathes. It has distinct rhythms, expanding and contracting as different global financial hubs wake up, hit the desks, and go to sleep.
So, here's our flight plan for this explainer. First, we'll look at the secret boss of the market, which is liquidity. Then, we'll cover trading the Asian session, jump into the explosive London-New York overlap, and finally, we'll figure out how to navigate the holiday trap.
All right, diving straight into Section 1, the secret boss, liquidity. Okay, so liquidity basically dictates everything from your spread costs to whether your stop loss actually works the way you intended. Think of liquidity like the water in a swimming pool. When the pool is super deep, meaning high liquidity, you can jump in and out without making much of a splash. But when that pool is shallow, even a tiny splash causes massive ripples. High liquidity means tighter spreads and fast, super accurate order fills. It's the engine of the whole operation. And when we look at the institutional breakdown of this, it's fascinating because major players aren't just looking at the sheer volume of trades. Actually, scratch that. They are deeply analyzing the quality of the liquidity. Notice how they weigh vital, complex factors like rejection rates, market impact, spreads at varying volume depths, and exactly how long it takes for order books to replenish. They're also hyper-focused on liquidity around major inflection points, like where thousands of retail technical stops are resting. The big takeaway here, professional money evaluates the environment before placing a single trade. And honestly, we should be doing exactly the same.
Moving right along to Section 2, trading the Asian session.
There is a really stark contrast to point out here. The Tokyo session, which kicks off the trading day, hums along with much lower volatility and just a generally slower pace. Because the massive, heavy-hitting volume of Europe and the US is completely asleep, non-Asian pairs usually just consolidate. But here's the cool part. It is highly respectful of technical boundaries. That means clear support and resistance levels usually hold firm. Contrast that with the Western sessions where you see massive liquidity floods, explosive breakouts, and really aggressive trend reversals. So if you were trading during these hours, these really need to be your go-to instruments. You want to focus on pairs tied directly to the active regions. USD JPY is the heavyweight here for sure, driven mostly by Bank of Japan signals, and it offers a very manageable average daily range of about 30 to 40 pips. AUD USD is also fantastic during this window. It's largely driven by commodity correlations like iron ore and gold, moving a very predictable 20 to 30 pips. Basically, these pairs offer distinct, structured movements while the rest of the financial world is literally snoozing. Now, since the market isn't exactly prone to wild breakouts during these hours, you can comfortably deploy a highly structured range trading strategy. This is where your oscillators like the RSI and stochastics really shine. They'll clearly signal overbought or oversold territory within an established channel. You can target very safe risk-to-reward ratios. For instance, you might risk 30 pips just above historical resistance to potentially capture 80 pips on the swing down. But listen, you have to be hyper-aware. The exact moment the London market opens at the end of this session, boom! Instant liquidity floods the market, and those reliable little ranges often shatter into explosive breakouts. Which brings us perfectly to Section 3, the London-New York overlap. 70%. Just let that sink in for a second. That massive number represents the staggering amount of daily global Forex volume that occurs in just a tiny 4-hour window between 1 p.m. and 5 p.m. GMT. London accounts for roughly 38% of global volume, and New York brings in about 17%. So when they operate at the exact same time, you get the absolute deepest order books, the tightest spreads, and the most decisive institutional movements of the entire day. It's the main event. Let's actually walk through this timeline chronologically so you can see how the window operates. At 12 p.m. GMT, we get the warm-up. U.S. traders are hitting their desks, grabbing coffee, reading the morning news. By 1 p.m. GMT, the core overlap officially begins with maximum institutional volume. Then, right at 4 p.m. GMT, brace yourself. We hit the London fix. This is when major global corporations and pension funds execute massive, mandatory daily transactions to set benchmark rates. It creates extremely wild, though somewhat predictable, price action. Finally, at 5 p.m., London goes home and the overlap officially closes. And guys, this is where the real fireworks happen. The overlap hosts the release of the most market-moving U.S. economic data on the calendar. Look at non-farm payrolls, the NFP, dropping on the first Friday of the month at 1:30 p.m. GMT. We are talking about a typical 100 to 250 pip spike on the Euro-USD in just 30 minutes. CPI can easily trigger an 80 to 150 pip move. The largest informed capital in the world is reacting to these numbers in real time right inside this specific window. So what's the game plan? Well, when trading these high-impact releases, patience is literally your only shield. Do not get caught up in the initial chaos. That initial 1 to 5 minute spike is very frequently a manipulation move. Your spread might temporarily widen from half a pip to like 10 pips in a blink. The smart strategy here is to just wait 15 to 30 minutes. Let the institutional flow actually settle, let the spreads normalize, and allow the true directional bias to reveal itself. Then you enter on that confirmed secondary move. Let the amateurs gamble on the initial spike. We're here to trade the established trend. Finally, let's wrap up with Section 4, Navigating the Holiday Trap. It is honestly shocking to see how much a single bank holiday throws a wrench in the whole ecosystem. Under normal conditions during the London peak, your Euro-USD spread might be a razor-thin 0.1 to 0.3 pips. But on a holiday, that spread instantly widens to 2 to 5 pips. The bank holiday literally evaporates the liquidity. Suddenly, your trading costs are multiplying by up to 10 times for the exact same trade. Let's look under the hood of this holiday trap for a second. When a massive hub like New York or London just goes offline, you see a 60 to 80% drop in overall market liquidity. With order books this insanely thin, your stop-loss orders are incredibly vulnerable to severe slippage. A stop you set for a 20-pip loss could easily get filled at a 40-pip loss. Plus, the market kind of loses its memory. Traditional technical patterns fail, false breakouts are everywhere, and even minor news headlines can cause completely erratic intraday price gaps because there just isn't enough institutional volume to absorb the shock. Look, if you absolutely must trade during a holiday period, you have to play defense. These steps are mandatory to protect your capital. First, severely cut your standard position size down to 1/4 or maybe 0.5% risk. Second, you gotta widen those stop losses. The tight stops that work beautifully during the overlap will just get stopped out by pure noise in a thin holiday market. And finally, know when to just walk away. On December 25th and January 1st, the market is functionally closed. Go enjoy your family, relax. There is absolutely zero edge to be found on those days. So I'm going to leave you with this provocative thought to chew on. If you take away anything from this explainer today, let it be this. Success in this environment isn't just about reading the charts. It's about reading the time zones. Look at your strategy, look at your daily routine, and really ask yourself, are you truly trading the market's deepest, most high-probability rhythms? Or are you just trading whenever your personal clock happens to allow it? Something to think about. Thank you so much for joining me today, and keep exploring.